Hello, welcome to the Hard Money Podcast, a new podcast that'll be featured exclusively at Real Estate Daily Magazine and Lulu Capital Inc. I've got my partner in this, Justin Hubbert, on the podcast with me today, and you're going to be seeing a lot of the both of us coming up. So, Justin, you've been doing hard money private capital for quite some time now. How long?
Yeah, well, welcome, friends. I've been doing this since 2006, so
Okay.
yeah, a couple of years of experience there.
Yeah,
So
you got an idea what you're doing. Okay, you got an idea
yeah,
what you're doing. Just to get right to it, Justin. We get asked this quite a bit when it comes to private capital funding, and a lot of people call it hard money. I like private capital better. It sounds nicer, right? So we get into private capital funding. A lot of people want to do fix and flips, but there's calculations that go into this, right? So especially if you're kind of a first timer, you've never done it before, you need to understand what those numbers look like and how a lender such as Park Place, you're the president of Park Place, and I'm the president of Lulu Capital. We work together. How a lender such as us, we go through calculating what you can borrow and how it all looks. So you go ahead and share your screen. You put together a nice little spreadsheet where we can kind of walk through this with everybody so they can just get an
yeah,
idea, of what they're looking at. And I love the numbers that you picked because I think they're very reasonable numbers. So,
yeah. So here's kind of our sheet that we'll come back to in just a minute, but this is our kind of simple fix and flip, and I appreciate everybody joining us here on this too. And so this is kind of an easy example for somebody that's maybe a first time flipper, or could be somebody that's flipped 20 homes. Some of your key data points that I put there in blue for you guys to look at. So let's just start with kind of your standard fix and flip, a 1 to 4 family, where we have a purchase price of 500,000 and a rehab amount of 100,000. So your $600,000 total costs, and then we're going to resell it for 750,000. Those are
okay.
kind of your standard numbers you see, on a lot of fix and flips where you have kind of a 20% gross up margin off your total costs.
Got it. Got it. So in this scenario, again, let's for the person that's never really seen this, who's thinking about doing it, let's say they found a property, it needs a lot of work, right? It's a $500,000 place. It's going to need about $100,000 worth of work. Now, Justin, real quick, how do they determine the amount for the rehab? Are they getting a contractor to run through the property and giving a bid? Is it as simple as that?
Yeah, so there's a few different ways. We don't require a contractor if you have experience in the construction or rehab business.
Okay.
Maybe you're a roofer, maybe you're a plumber, maybe you're a tradesman of some sort. Then you can be your own GC on the project. And
Okay.
so it could either be from self determined numbers, or it could be from a licensed GC that determines the numbers. One of the keys there, Frank, is on this is that you want to make sure as we kind of expand this rehab budget, and let's just say this was 300,000. The more the rehab budget is, the more experience you're going to want to be able to have, and we're going to want to be
Yeah.
able to see. Make
Yeah.
sure that if you're knocking walls down, that we know what the 2x4s cost, and you know what the plumbing costs are. Just as two examples.
So when you get when we get the information on the property and we talk to the person that wants to do the fix and flip, we get the scope of the work. Like, what are we trying to do here? What's the cost of the property? What do you think the cost of the work is going to be? And so from there, we can kind of judge and figure out, what we can do as far as lending is concerned. But in this scenario, let's say, $500,000 purchase price, the person has some experience with fixing up homes or whatever the case may be, goes, dude, 100 grand, no problem. Do they just give you a letter basically saying I can do this for 100,000 bucks? Do they list out what they're going to do or anything like that?
Yeah, good question. We have a glorified Excel sheet that they'll fill
Got it.
out and kind of say, "Hey, A, B, C, D. Here's our of what's needed."
Okay.
That might include like a roof, or it might include a plumbing. It could be a variation of things. It could
Yeah.
be 30 items. But the one thing I encourage everybody to do when you do complete those is, and this is for pretty much any lender out there, is you want to make sure that those data points are actually something. If I showed you a photo of before and after, that you could say, yes, it's completed, or
Mm,
maybe
got
B,
it.
it's in the middle of being completed. So that works great with, like, if you said new carpet, but it doesn't work so well when you say living room, right? Because it doesn't give you a definition of what
Oh,
improvements you're going to do.
understand. You got to itemize what you're going to do, right? Carpets
Yeah.
throughout. all new windows, new roof, new HVAC, whatever you may be doing, something you could take a picture of before, picture of after, very, very clear what you did. Okay, cool, man. Cool. So in this one, we're doing a newer person, right? Someone who's new to fix and flip. And how do we gauge if you're experienced or not?
Yeah, so a few different data points here that are relevant when you're kind of looking at this. The three data points that are the most relevant for profitability is just your purchase price, the rehab amount, and the after repair value.
Okay.
Then we look at credit. There are some credit minimums there. We require a minimum of 660 credit. We will
Okay.
make some exceptions from time to time if you put more money down.
Okay.
We do look at your assets. We're not 100% lender, so there's always these kind of you know lenders out there to claim 100% financing and things. That's not what we do. We're more institutionalized in the aspect of we require a down payment every time.
Sure.
And then we look at the experience, which you asked, about Frank. That goes back 3 years of how many flips or rental properties have you had in the last 3 years. So,
Okay.
and we quantify that by number of exits, not necessarily number of starts, because let's just say you started a property and you're still rehabbing it. That's fantastic, and we're excited to help you on that journey. But what we want to do is see that you can get to the other side. And the real success here is, and the profitability for any flipper is the actual sale of the property, not the purchase. So experience goes to the number of basically flips that you've had to an exit.
So what are you looking forward to? Are you looking for three in the past 3 years? Four? How many exits are you looking for? Like to say, okay, your experience, because if you're experienced, you can get a little better, you can do a lower down payment, correct?
That's right. Yeah. So we go by loan to cost, and so or purchase amount finance. So if you're a first time flipper, we love working with you. I would say like 20 to 30% of our portfolio is first time flippers. So we work with a ton of first time flippers,
Mm,
and so we can help you kind of along the way. So our total costs, we will end up to 85%. So what is that total cost? It's just your purchase price plus the rehab amount. So that does not
got it.
include interest or closing costs or anything else. It's just a simple calculation. And then we'll lend you up to 80% of the purchase and 100% of the rehab. It's the lower of these numbers. So whichever of these numbers is the lower of the numbers is what plays. So if the loan to cost in a heavy rehab scenario might mean that you have to put a little bit more money down than 80%.
Got it.
Um,
Okay.
and then we limit ourselves to 80% to 70%, I'm sorry, of the after repair value. So that's just after the house is completed and renovated, what is the value? And our total loan is basically 70%. So
Okay.
let's go up here to an example, if that's okay, Frank.
Yeah.
Where we have a purchase price of 500,000. We have an 80% that we can finance on the purchase, 100% of the rehab, and then the after repair value, or ARV, is 67%. And how we got there is basically we will finance 400,000 of the purchase plus 100,000 of the rehab. Kind of leads us to a total down payment of 100,000 and a total loan amount of 500,000.
Great. Okay. Terrific.
Now let's talk about the down payment, because that's usually the question that so many people call us with is how much at the end of the day do I need down payment wise? So there's two questions that need to be answered there. There's a cash to close, which is shown right here. So let's just use for this example the 100,000. Let's just assume with taxes, insurance, title, third party fees, and then the points to originate the loan, that it totals 3% of the total loan amount. So in that scenario of 500,000, that'd be 15,000. So we just add those two simple numbers together. You need $115,000 to close.
Got it.
However, Frank, there's always a question that a lot of people ask and say, is that all I need down? The short answer to that is yes, but no. And the reason why I say that is you need to have money for reserves, because you need to be able to kickstart the project. You need to make sure that you have enough money to actually get to the finish line and make the payments along the way. So how do we do that? We kick into a reserve calculation. These are monies that stay in your bank account. We're just literally showing those that you have the ability to get this thing to a successful exit and for you to make money. And so the calculation is basically 6 months of the total payment plus 10% of the budget of the construction. So in this scenario, with $10,000 budget, we use an example of a 1099 rate. Go back down here, we just do the simple calculation. is 37,000 reserves. Again, Frank, that saves completely in your account. We just want to see that you have that to kickstart the project. So
Yeah,
just
you're just
simple
making
addition.
sure that they've got the capacity there. Plus, like, okay, we budgeted 100 grand to fix it, and like, oh crud, I missed this thing, and it's going to cost me $7,000. You know what I mean? Oh, great, we've got it. We've got the money. So yeah,
Yep, bingo. And so just adding those simple numbers together, you need about 152,000, 153,000 that what we would deem to be successful on this project.
got it.
However, can we go through an example of somebody that has experience?
Yeah, let's do it.
Okay. So
Yeah,
you need less 15% down. So now you would only need 15%. So here's the experience bucket right now.
yeah,
So go up to loan to cost of 90%, which is basically 85% of the purchase, 100% of the rehab. And so if we did this here, we'll go to 85% here. And so in that scenario, you put a little bit less money down, 90,000 plus the reserves stay kind of the same. So you're talking about 130,000. And the reason why, Frank, that most lenders want to see experience to give you less money down is just that, again, goes back to like, we want to know that you know what a 2x4 costs. We want to know that you know what a hole in the roof would cost and what it takes to repair. That's only done usually through experience.
right,
However, as you're using a licensed GC, we do take that into calculation into account, so we can always have those discussions as well
right.
about giving you higher leverage if you have a licensed GC.
Yeah, the thing about private capital that's really cool is, like you just said, hey, well, you got a licensed GC. Well, let's talk, right? I mean, when it comes to private capital, it's about having a conversation. What's the scope of the work? What's the plan? What are we trying to do? And you guys can really tailor things, right? Nothing's permanently set in stone, right? It's firm guidelines, but there's some flexibility because it's private capital, right?
That's right. Yep,
Yeah,
that's exactly it. The nice thing is we don't require any tax returns, any DTI calculation or debt to income calculation. We don't look at any income documents. It's basically the property and then some small credit checks, if you will. We only do a soft pull on credit, so it doesn't report to credit, and it's basically kind of an all or nothing on the credit score. So there's a lot linear guidelines than if you looked at, say, somebody that was trying to get a Fannie Freddie loan for their primary house that I know you help a lot of clients with. So
yeah,
the,
yeah.
the guidelines are lot looser, and because of that, we're able to close these loans in kind of 3 to 5 days. We just took a guy that kind of was in a urgent need. Another lender didn't work out for him, and so we were to go in that deal last week. We went in 24 hours, door to door, to close
No
it.
kidding.
So we can close these extremely fast for somebody if we need to.
Right, right. This is great stuff, man. All right, Justin, do me a favor, stop the screen share real quick, and
Okay.
we'll chat about some stuff, and we'll get on out of here. So, what I would say, guys, is if you want us to look at a scenario for you, right? If you're like, okay, I think I want to do this. I got a house in mind, right? I think I know what it's going to cost me. I'd like you guys to go through this and tell me if I can pull this thing off or not, if I can do it. All we would ask you to do is just, if you're watching us on the magazine or on the Lulu Capital blog, just if you scroll down below, there's a little form down there, a contact form. Just put it in there, your name and your stuff and what you're looking, what you want to chat about. Hit submit. Justin and I will get that information. We'll call you right away. We'll start crunching those numbers and figuring out exactly what you can do. If you're watching us on YouTube, just go into the description. There's a link for the contact form. You just click on that link. The contact form will pop up. Just fill that out, and then it comes over to us, and we'll go through.
Frank, let's do one other thing, my
Yeah,
friend. If you want a calculator, you want us to send you that calculator, just put your name and number in there or email, and we're happy
yeah,
to send you this calculator. I think that'll be really helpful for a lot of people that are starting out, or maybe somebody that even has experience there to be able to kind of get the high level numbers. One thing we didn't show on there is the actual payments. It has a payment calculator as well. These are interest only loans, so you kind of have a minimum amount. It's just like a credit card. As you spend the money, it goes up on the balance, and the payments go up. We're happy to throw that in there too, and talk through that too. So just put your name and email in the link if you want that,
yeah.
and just give us a call and we can get
We'll
that to
send
you.
you the calculator. Yeah, we'll give you a call. We'll send you the calculator, and you're good to go. So great stuff, Justin. Hey, well, we'll come back next time, Justin, with maybe some real scenarios. I think that would be really great to look. So here's the property. Here's what it cost. Here's what they put into it. Here's how it looks on the end, and here's what they were able to sell it for. That I think would be really, really cool to check out. So we'll do that. All right. Sound good, Justin?
Sounds awesome. Yeah. So good connecting with everybody. Look forward to it. So.
Right. Thanks so much, guys, for tuning in. Reach out to us, and thanks for joining us here at the Hard Money Podcast, featured at Real Estate Daily Magazine and at Lulu Capital Inc. We'll catch up with you guys later. See you. Bye-bye.
Adios.